If you're currently trading the wheel strategy and you are concerned about a market correction or how the strategy will actually perform in a bear market, then this video is for you. Because what I'm going to do is outline how I traded during the 2022 bear market, what differs from trading in a bull market versus a bear market, and then things I would do differently the next time we get a correction. If you don't know who I am, my name is Oliver El-Gorr. I run a company called Freeman Publications, and I've been trading the wheel for the past 6 years. I've written a best-selling book on the subject, and I've helped over 350 people successfully make side income using the wheel strategy. So in this video, I'm going to outline my results for 2022, how I traded, some of the mistakes that I made, and also what I would do differently when we do get another correction. Now, I'm not going to predict when one will come. I'd rather just be prepared for when it does. So let's get into it and let's walk through how I traded during the 2022 bear market. And the reason I'm making this video is because I think there's a bit of an issue about learning from people who only have limited experience. And don't get me wrong, there's a lot of people who have made really good money with the wheel in the past couple of years. But if people have only been trading since really the beginning of 2023, then they don't have the full spectrum of experience and context for how to trade the wheel if the market isn't just up and to the right. Because realistically, you could have done 60 to 80% a year over the past couple of years if you just traded high IV stocks like the crypto miners like Marathon, Riot, or if you just traded SOXL or other sort of leveraged semiconductor plays, or really if you just traded Nvidia and Palantir, you would have had a really, really good time. But the issue with that is it kind of works until it doesn't, because it doesn't work if the market isn't just up and to the right. And I've seen people on social media claiming that they can make, 70, 80, 90% in a good year, and using those same exact tactics, they can make 3 to 5% per month in a bad year. But you can't be making 50% a year with the wheel in a year when the market's down 20%, unless you're benefiting from hindsight. But I don't care what these projections say or what these plans say. The reality is very, very different. And if you tried to trade those same stocks during 2022, you would not have had a very good time. So what I'm going to do in this video is I'm going to walk through how I traded the wheel in 2022, which was a very tough year for the market. I'm going to share my actual results, the challenges that bear markets bring for wheel traders, and then really the sort of expectations you should have if the market isn't fantastic like it has been in the past couple of years. And so first things first, and this is kind of the key factor behind all of this, is while the overall market may decline, not every single stock goes down during that period. And this is because market benchmarks are weighted. The S&P 500, the way it's measured, is not just 500 equal weighted stocks. And right now, because of this shift and how much money has gone into the Magnificent Seven, they are a huge part of that index. 32% of the SPY is in just 7 stocks. 32% of the whole index is in just 7 stocks. And here's the heat map from January 27th, 2025. This was the DeepSeek day, if you're not too familiar with what the meaning of that day is. It was when DeepSeek was released to the markets. It was a huge day, all the headlines. Nvidia loses the most money of any public company in one day. This is Armageddon. It's the start of the next bear market. It's horrible. The SPY was down 1.4% that day. 4 out of 11 sectors were actually up that day. And more than 50 stocks were actually up 2% that day. And you can see here from the heat map that there's a massive red square in the top left with the semiconductor stocks, and Nvidia, which is the 3rd or 4th largest stock in the index now, Broadcom, which is the 10th largest, and other large cap stocks like AMD, Micron, Intel, Qualcomm. These make up a decent portion of the index. And some of the other big tech stocks got dragged down. But then look at everything down here. It's a sea of green. So that's lesson number 1 here. Just because the market goes down, and this is over a 1 day period, 1 month period, 1 year period, just because the market goes down does not mean every single stock is plummeting simultaneously. So here are the facts over the last few years. The SPY finished 2024 up about 24%. 331 stocks were up, the remaining 169 were down. So about 2/3 of the index was up, 1/3 of the index was down. And this tends to hold true for most years. On an individual level, these were the best performing stocks. You don't have to be a genius to work out which ones are at the top. Palantir, Vistra, the AI data center stock, Nvidia, of course, United Airlines sneaking in at number 5 there. But then the worst stocks in the S&P 500, Walgreens Boots, Intel, Moderna. This is actually an interesting one. Moderna was the 3rd worst performer in 2024. It was also the worst performer in the SPY in 2023. So that's a rare feat, and it will probably get kicked out of the index soon, if it's not already. We've got Celanese, or Celanese, for my Italian friends, and then Estee Lauder rounding out the list. Now, let's go to 2022, the bear market itself. The SPY was down 18% that year. 73 stocks were actually up that year. So, horrible year in general. Almost 1/5 of the index actually finished up. The energy sector was by far and away the best performer. It was the only sector that was up on the year. But you had stocks like Occidental Petroleum, Marathon Oil, Defense and Aerospace actually did pretty well that year. Northrop Grumman, Lockheed Martin were also up. And even within industries that didn't perform too well, there were still individual stocks that did outperform. Lowe's in consumer discretionary, T-Mobile in communications. So the second lesson here is there's always something that is tradable. And the big benefit of the wheel is it gives you flexibility. My long-term portfolio in 2022 was down 42%. Because in my long-term portfolio, I hold a lot, pretty much only growth stocks that I hold for the long term for capital upside. And most people could not stomach that level of volatility in their long-term portfolio. And to be honest, even in the past couple of years, my life circumstances have changed. I'm a dad now. I don't particularly know if I could stomach 42% drawdowns in a single year in my portfolio. But my wheel portfolio was up 8% in 2022. Now, on the surface, that's not, life-shattering or life-changing results, but I'll explain why I was very happy with that. The reason for that is I could rotate my wheel portfolio into stronger performing stocks and sectors. And I could still make income from selling covered calls as well as selling put options. So how do you trade in a bear market? What specifically do you do? What was I doing anyway? So first of all, I'll talk about what you don't do. And what you don't do, this is a very common mistake, is try trading the volatility directly. So in other words, you're trading stocks or trading ticker symbols that are directly linked to volatility. And this sounds logical because volatility spikes when prices fall. So you think, when stocks go down, anything related to volatility is going to go up, therefore it's going to be a good trade. Doesn't work that way. Bear markets are not a one-way slide down. They are punctuated by mini rallies, large days of individual gains. For example, in 2022, SPY had multiple days of 5% gains for the index. Now you might think 5% gains in a day? That doesn't happen very often. It actually happens more often in bear markets and at the end of a bear market than it does in bullish markets. In fact, mid-June to mid-August 2022, there was a 17% rally in the index before we had another pullback going into sort of September, October time when the market actually bottomed. So if you trade volatility tickers like VXX and UVXY, that is not going to do you any good because these tickers, they reverse just as quick as they go up. So you're trading something that's incredibly choppy and you're not going to get the consistent gains that, that's what you do the wheel for, and it's just not worth it. VXX, which is a just straight up you're betting on the VIX, VXX was down 48% in the second half of 2022. So you'd done really, really well the first half of 2022, then got absolutely creamed the rest of the year. So we're not going to trade volatility directly. So here's what we are going to do. First of all, we're going to use the VIX as a sort of gauge for where we will and won't trade, because knowing when to not trade is just as important as knowing when to trade. So don't trade above the red line. And the red line is literally when the VIX is above 30. Now the VIX is below 30 the vast majority of the time, especially in good markets. I'll explain more on the next slide. But during periods of volatility, the VIX spikes. So we had 4 different periods of more than a week in 2022 when the VIX was above 30. This was about a 6-week period here at the end between the beginning of September and then the end of October. So I didn't really trade at all during that 6-week period. And we were punctuated by this throughout the year, which is part of what makes trading in a bear market so difficult. But just by not trading during the most volatile periods, you're going to save yourself from the biggest losses. So only trade when the VIX is below 30. And once again, this is counter to how a lot of people think about trading in a bad market, because the argument is that, oh, when the volatility is high, that's really good for option sellers because the premiums are going up. The premiums only go up because of the volatility. Volatility in the stock market means stocks are going down. We don't get massive volatility spikes when things are going up because things tend to go up slowly and steadily, earnings calls notwithstanding. I don't want high volatility. If I could have the VIX at 12 for the rest of time, I would take that 100 times out of 100. And the fact is, 2023 and 2024 were such good years because the VIX was below 30 for every single trading day of 2023 and all but 5 trading days in 2024. If you're interested in which 5 days those were the ones at the beginning of August when we had the yen carry trade blow up. And I made 33.8% in 2023 and 36.5% in 2024 because guess what? Conditions were a lot easier and therefore the results are a lot better. Another big factor here is momentum is key. Momentum is really the only technical factor that has a lot of reliability in a shorter term time period. And so this resource is really useful. This is from the Muscular Portfolios website. I'm not going to go too deep into what that strategy is, but it's essentially rotating into the strongest sector every month. But this is actually a really good gauge of which sectors are best to trade at any given time. So you look at, I've got 2 screenshots here, May of 24 on the left and then January of 2025 on the right. And you can see gold has been the best performing sector if we average out 3, 6 and 12 month gains. So if you're going to be trading, then gold's a pretty good place to start. You see here, large cap growth and large cap value are both there as well. And then you see the sectors that haven't done so well. You know, for example, commodities basically been flat if we average out the past year. T-bills, you know, that's what we would expect to be lower down. But even things like emerging market stocks going from an average of a 12% gain to an average of a 4% gain. So that says to me, well, maybe we shouldn't be trading emerging markets as much right now. And guess what? In 2022, this looked very different. Gold was definitely not the best asset class to trade. Guess what was? Energy. So that's why you've got to be stock agnostic. Energy was the only sector up in 2022. So guess what I did? Traded a lot of Exxon, traded a lot of Chevron, traded a lot of Occidental Petroleum. Is it Occidental or Occidental? I never remember. Now, would I want to own these stocks long term? Not particularly. I don't really want to own cyclical stocks in my long-term portfolio, but I'm happy to trade these and then be assigned for a month or 2 if they pull back. Because as long as a company has a strong fundamental base, I'm happy to use it for the wheel. And this is why I mostly trade mid and large cap stocks. I'm not trying to get rich quick trading penny stocks or trading these obscure companies. If I wanted to do that, I'd just buy them and hope for the best. But the wheel is win little, win often. So if your upside is capped by design, you don't want stocks with so much upside. You want steady performers for reliable income. Certain stocks as well do decent when the market is bad. For example, AutoZone and then O'Reilly Automotive, these were up more than 20% in 2022 because guess what happened? We had a car shortage because there was a lot of supply chain issues, especially with semiconductors. When there's a car shortage, people repair vehicles instead of purchasing new ones. Also, inflation was out of control. I will say these two in particular are quite difficult to wield because they do have very high stock prices. AutoZone in particular is one of the most expensive stocks on the entire market. It's about $3,300 a share. Other stocks that do well in bad markets, the big discounters, Walmart, Ross, Dollar Tree, you can throw in Dollar General in that as well, although fundamentally the company's in a bit of a worse position than Dollar Tree is. Now, these did do better in 2008 than they did in 2022 due to, once again, the supply chain challenges that I just mentioned, but they all did better than the broad market. Walmart was down 3%, Ross was down 4%, Dollar Tree was up 7% in 2022. They would not have been bad stocks to trade during this time period. Now, you may be thinking, well, Oliver, mate, if energy was up 30%, how come you only did 8%? Surely you would have just got the same results as the energy sector. Well, I didn't, and here's why. First of all, these stocks, a lot of them have lower premiums overall than the typical stocks I would trade, and I'm going to get into that in a little bit about why that's okay. Low implied volatility means lower premiums. Walmart typically hovers around a 25% IV level. You'd be lucky to get 1% for a 30-day, 30 delta trade. The energy stocks even lower. Exxon and Chevron are low 20s. You're looking at 0.8 to 1% for a 30-day, 30 delta trade. The other part of this is, as I mentioned before, the VIX was just too high to trade at certain points. So I would go 2, 3, 4, at 1.6 weeks with no trading. Just doing covered calls, so I'm not entering any new trades. My goal in that period is just to avoid losses. Because if the index is down 10% and I'm at 0 for the month, I'm considering that a win. It's not a win because I'm not making money, but when the rest of the market is down, if I'm flat, I'm preserving my capital. So I'm okay with that. And that's why, like, if I'm getting out of the year with an 8% gain when the market's down 18, I'll take that 100 times out of 100. The other part of this that I think is worth investigating is alternative asset classes. And this is not a pitch for gold or silver or platinum, whatever it may be. We can use certain ETFs to our advantage in trading. Now, gold was relatively flat during 2022, but once again, that makes it quite useful when stocks are very volatile. And you can use ETFs to trade gold with the wheel. And you can use certain stocks and ETFs to benefit from that. For example, gold, which is Barrick Gold, IAU and GLD, which are ETFs tied to the price of gold. The same goes for things like oil prices or natural gas, USO, UNG, two ETFs that trade in line with those prices. That can be an effective strategy. But it's not just the ticker symbols that you trade that matter, it's how you actually trade them. So there are some adjustments that I make to my trade entry process if the market isn't doing as well as I would like. And a big one of those is how aggressive or conservative we're being with our trade entries. I always want to err on the side of being conservative because as volatility rises, so do option prices. So I might now get the same payout for a 25 delta trade as I do for a 30 delta trade in a better market. I don't want to make huge money in markets like this. I just want to ride out the storm. I just want to get to the other side with my capital intact. And any gains I make, that's a bonus. Once again, the goal in a bear market is really just to survive and wait for better conditions. It's not to be Michael Burry. As glamorous as it might sound, of, oh yeah, the market was down 50%, but I was up 400%. The level of conviction that you have to build trades like that, number one, those aren't 30-day trades. Those are multi-year positions that you built conviction in. And you have to hold them when everyone's telling you you're an idiot, which is a lot harder than it appears in a movie. The other part of this is bankroll management. You've got to de-risk for your own sanity. More cash, less actual trading. In 2022, for example, remember I-bonds? Those were great. 9% you could get. And yes, you could only put $10,000 in them, but that was essentially free money. Free $900, great. You'd get 5.5% in a money market fund, great. There's no harm in taking less trades if the conditions are not to your favor. And don't get yourself in a portfolio. This is the other thing I see. People say, oh, I'll just sell covered calls. Well, that's great. But if you're just in a bunch of downtrending stocks, yes, you're making some income, but your capital's being eroded. Another part of this is how we're actually going to stagger our trades in terms of where we're trading when we're doing multiple contracts. So I've got a graph up here. This is just AMD towards the end of 2023. And the reason I'm showing you this is to do with support levels in trading. So AMD had a nice rally towards the end of 2023. And here's how I would think about it if the market isn't so hot. Now, rather than doing 5 contracts at 30 delta, which is like the kind of the standard approach in a good market, ladder down the contracts, split the strikes. So we got, if you're doing 5 contracts, do 2 at 30 delta, 2 at 20 delta, then 1 at the support level, which is like a 16 delta. Just take risk off the table. So even if you get assigned at those 30 delta ones, you're still going to expire out of the money on the less aggressive strikes. So there's still a bit of profit in the trade, and then you get to keep more of your buying power rather than being locked up in a larger covered call now in a downtrending stock. If you're going to be trading really high IV ticker symbols, I actually suggest you go even more conservative on this. So for example, if you're doing marathon, say you got 20 contracts in Marathon Digital, which is like $30,000-ish of buying power, I would do 8 of them at the 10 delta, because you're still actually getting 2% there. So that's a really generous trade as it is, but don't be greedy. Don't do 20 contracts at a 30 delta just because you're getting 7%. Because with the volatility comes the downswings. You're going to get taken out. You're going to get stuck holding these huge underwater covered call positions that you simply do not want to have. Because even if you're trading high IV stocks, and I really don't recommend you trade these in a bear market, but people are going to ignore me anyway, you've still got a premium of 3.43% if you weight it across all of these strikes. 3.43% for a 30-day trade is phenomenal. That's an incredible return. Be even more conservative than this, but do not get greedy, especially when the conditions are not to your favor. I have this concept that I call controlled aggression in trading, and it has to do with the conditions of the market versus how aggressive you are. 2023 and 2024 were phenomenal years for running the wheel. And it's worth being aggressive when conditions are in your favor. You take what the market gives you. Not every year is going to be like this. 2022 certainly was not. And knowing when to be conservative is so important. If the VIX is above 30, if volatility is all over the place, if so much stuff is going down, if you get 0 returns in a month when the index is down 13%, which it was between early September and mid-October of 2022, it was down 13% in 6 weeks. If you get 0 in that period, you came out ahead. So that is controlled aggression in a nutshell. And finally, I want to talk about what happens when this happens again. And for what it's worth, I'm not in the business of making market predictions. I'm not going to say, oh, we're going to get a correction tomorrow or next week or when Trump says this or that. I don't play that game. I just prepare for when it does happen. I would run largely the same playbooks, but with a few tweaks. I would be more conservative, and I would probably trade more non-equity tickers in high VIX environments. So the VIX is obviously the measure of volatility in the stock market. It doesn't take into account things like gold, things like treasury bonds. So TLT, which is a T-bill ETF. Now, I didn't trade this at all in 2022. I have never really traded it at all. Cut. And to be honest, I've never traded it up until this point just because I haven't needed to. The market's been good. But when the market turns, something like TLT, which is a bit more consistent, may be worth adding to your arsenal. And I'm certainly going to experiment with trading it when the conditions aren't as good as they have been for the past couple of years. So that about wraps up the 2022 trading report, I guess I should say, of how I made 8% using the wheel. If you enjoyed this video, give it a thumbs up. If you want to learn more about what I do, how I work with people, how I help them out, trading the wheel for reliable income, there's a link down below, and there's also a video that will come up on the bottom left with me literally walking through how I find stocks, how I enter trades, and all of that good stuff. So I hope you enjoyed this video, and I will see you in the next one.